Thanks for tuning into Talking Point. I'm your host, Neeraj Shah. A bunch of things that the earnings season is throwing up. There is a hint of positivity amongst companies which are rural focused, and you can see that in two-wheeler results. You're starting to see that in the way the margins of some of the consumer companies or staple companies are behaving. So that is part one. We've seen decent attraction in real estate, but not quite the same in information technology, again, and as expected. But with the ER&D companies coming out with results, can they actually outperform IT services? I think that's a key talking point too. And more importantly, with the Nifty just wedged in a tight range, if you can call it a range, does one have to compulsorily look below the hood in order to try and figure out what could happen to individual performers, or where is it that money can be made? I think those are the talking points with our guest today. Unmesh Sharma of HDFC joins us right now. Unmesh, great having you. It's been a while. Good talking to you. Thanks for joining in.
Thanks, Neeraj. Thank you. Always a pleasure.
Thank you. Unmesh, is that your thesis too? Because I've heard that now from a few people that one will have to look under the hood in order to make money, because the benchmark index may virtually go nowhere by virtue of the pulls and pressures on different components.
Yeah, so if I have to sum it up in one line, I don't think it will be very different from that. I think, I was just doing the numbers right now. Let's take a step back, right? The macro is not calling for an immediate rally. Okay.
True.
That's been the case since August. All right. Now there are two factors which have played out on both sides. Okay, let me say the positive first. One is there is no doubt that specifically India has done very well as far as, let's say, things like infrastructure are concerned. Whatever is to a large extent within India's control, whether it's the external vulnerability, whether it is continuous investment by the government, push into PLI and things like that, I think generally India has done well. So as compared to when we have faced an challenge environment like this in the past, let's say 2013, India is not a fragile economy anymore. So that sense we are okay. The long-term demographic story and all these are well known. I don't think I need to repeat any of that, right? So, and a lot of those are only accelerating. So in that sense, it's a nice place to be, right? Long-term. The issue is how do you navigate what is happening in the short term? One positive which has happened is that time has elapsed, right? So since last August, we've had this view that and we'll get into detail, but the broader macro is a little challenged, and that there will be disappointment on earnings, which has already kind of played out. So, earnings have got cut. FY23 now will give you something like 840 on the Nifty. But now what is happening is that we get to the next stage issue. So will we get the benefit of people now looking at FY24 and then FY25 as the year progresses? Answer is yes, we will get some benefit from that. So in that sense, the fact that nothing has happened for a while, that tight range that you're talking about has helped the market in that sense kind of come out. At the same point in time, we believe that the market yet again seems to have gone a little bit ahead on their earnings estimates for the forward number. So I was looking at Bloomberg, and what I found was that the consensus numbers for FY24 are anywhere between 16 and 21% growth. So let's say the consensus is like 18. We are at 12. Okay. So in that sense, we'll end up with the year at somewhere around 940. And honestly, we can't see very much risk on upside here. Okay. So this is our starting point. In that sense, markets, again, bounce back into the higher end of that range. So it's back to whatever, 17,800, 18,000, which means that you're at 19 times again. So if you look at the market, would you want to buy something which is more than a standard deviation above long-term mean? Answer is, in this kind of challenge environment, why would we do that, right? So I'll take a pause here, but what we are saying is that it's more of the same. Things are improving, but at the same point in time, there are other challenges which have improved, and the market's really not come up. So in that sense, we stay in this kind of doldrums, so as to speak, where you try to play within Nifty, you have to look for alpha, and then obviously, as you say, you look below the hood for other long-term thematics.
Since individual investors don't have Nifty futures in the portfolio, let me ask you that if there are macro challenges which you alluded to that you will get into, as well as the fact that if I buy the argument about the 12% earnings growth and therefore we're trading at maybe a standard deviation or thereabouts above long-term averages.
Yeah, more than one.
More than one standard deviation above averages. Can individual themes, because of a government push, because of China plus one factor, what have you, whatever is working for those, do well when the overarching pressure on the index is on the downside.
Sorry. So, look, let
When
me
we find outperformers essentially in a meaningful way.
Yeah. See, look, this is not like, okay. So, look, what's happened is that if you look at the market memory, we are used to seeing very big dislocations, and then V-shaped recovery. Okay, whether it was 2008, of course, it was a long V, but it was a V, and then you had the COVID issue, or even the mid-cap correction that you saw in 2018. Okay. Things go down, then things go up, and then you kind of try to get back to normal. This is not one of those scenarios. This is how markets used to be back in the day when I started my career, right? So, there is a long grind which is happening. Is there any reason for market to fall off a cliff? Answer is no. Okay. See, what happens is that if the market falls to 16,000, okay, hypothetically, we don't expect that to happen. I'm just saying if it happens, then it's easier because you say, if you are a believer, then you will buy. Okay. You may find it a little difficult, but you'll still do it because you say, at least I have valuation comfort. Right now, where the situation that you are in is that this is like, how the markets used to be in, let's say, the 99 to 2003 kind of time frame, or when the consumer companies used to just go sideways. Basically, nothing used to happen for long periods of time. Okay, and that is where truly alpha has to get generated, because you actually have to go out and work hard and look for ideas. Now, how do you do that, right? One is in a challenge macro, very, very difficult, and psychologically very difficult to go into the mid caps. Okay, because the first, or small caps at least, mid caps are now large in India, but I'm saying very difficult to go into small cap. Where first reaction is that whenever a correction will happen, this is where the dislocation will happen. Okay. The second is that within the Nifty, or for that matter, let's say the top 100 stocks, you're looking for alpha generation, and I think the strategy has to be a little bit nuanced in both. Okay, which means that you look for active strategies within the large caps as a large part of your portfolio. Let's say 80% of that has to be built out of this. Where are we looking at? It's nothing which you would have not heard on this channel before, or for that matter, what we've not said before. It's the selective names, large banks, for example, right? Or you look at long-term thematics. City Gas is there. There is financial inclusion. Some of the insurance names look good. Okay, then capital market names. Eventually, I think while there is some dislocation now, I think things will improve. You are also industrials are looking very good, which we anyways discussed. Then there is real estate, which we believe will continue to remain in this kind of cycle because there's a 10-year cycle. We believe it has just started. So from that perspective, there is enough place where you can push more money. Now, how do you fill up the remaining 20%? And that's really where the difficulty happens, because what will happen is that when we are talking about all of this, you are naturally finding yourself underweight on things where you have uncertainty. So rural is one thing that you talked about, right? But honestly, in this environment where there is this risk of El Nino, and there are multiple different thought processes happening as to what the monsoon is going to be. You hear it will be normal, but then there will be a special issue. There will be a temporal problem, which has been happening now consistently. Will we see a recovery in the consumer in an inflationary environment? Does that happen? Would you bet on that? Answer is no. Like, we'll know only in hindsight. So what happens is you are naturally underweight on the consumers. You're naturally underweight on some of the energy names. You're naturally underweight on some of the NBFCs, some of the smaller banks, right? So you have to allocate that money somewhere, which means that you start looking for basically interesting long-term thematics in the mid-cap space. We believe that between some of the themes that are talked about within the financials, within pharma, gas, insurance, and caps, that's basically how you construct a portfolio. It's not a very aggressive stance if you think about it. You don't want to miss the long-term thematics playing out either. But at the same point in time, I think that you should start with the thought process that we've been in some kind of market, challenged market scenario since, let's say, last April, definitely since last August. We are probably in the middle of that, maybe in the second half of that problem. We're not out of it yet. But if you're thinking 5 years, then you start staggering your investments in right now. And as a market participant, in any case, we believe that we stay invested in markets at our points in time. So this is how you would construct a portfolio and kind of sit back and watch. We don't see this scenario kind of improving at least till June, if not later. So it's time to kind of brace for the impact, so as to speak.
Or viewers, conversely, you have ample time to deploy your resources. Don't be in a mad rush to do that.
No, fair enough. While we don't advise sitting on more than 5% cash. If you see our model portfolio never goes beyond 5% because, you also have to, be humble enough to acknowledge the possibility that you are wrong.
You are wrong.
Okay. But at 18,000 market, whatever, 17,800 in the market with 19 times forward earnings, I think, you could stagger it a little bit here and there. So.
Got it. It was interesting. The El Nino impact is a bit of a wait and watch thing. But aside of that, most people believe, Unmesh, even economists believe that, and then political watchers believe that in a pre-election year, you would see heightened rural spending, which might essentially help the rural sector revive in calendar year 2023. You're not in that camp?
Okay, so look, I don't. It's a little. I have a slightly nuanced view on this. Okay, I don't think any government is going to risk a slowdown in the run-up to election. This is not true for India; it's globally. Okay, you see, it never happens.
Right.
Why would you do that? Right? Why would you inflict pain on a population the year before? Honestly, in any case, why would you do it? Now, is this, however, a reality which was much more stark before, let's say, the 2009 elections, the elections before the year 2009? I think the answer is probably yes. That, you used to really look for cues from the government. The manufacturing push is something that I think will happen. The infrastructure push is something that will happen. It can get accelerated a little bit, but honestly, there is anyways feverish activity at that side. And I think the government, my reading is that they have figured that actually this is one place where visible returns can be felt by the population and have economic and electoral gains. Okay, and luckily all of these are aligned. Okay, so and that is in line with what the market wants as well. So there is no confusion. Now, as far as the other part is concerned, I will try to second guess what you are asking. Okay, what happens in the past has always been that what is the positive of spending in the rural economy? That the economy revives and the trickle up effect happens, right? No problem with that. Because anyway, the government through direct benefit transfer has now made it adequately clear that is the way they want to go. I don't think that anyone should be surprised by that. The question really that is that if situation is bad, then does that mean that the government will be forced to open up the coffers, which means that we will face an external vulnerability issue? Mm-hmm. This is the real concern in the mind of the market. The market's not concerned about 5 stocks doing badly. The bigger implication is worse. Now, as far as El Nino is concerned, look, as compared to, let's say, of course, we can do a lot more, but at the same point, as compared to 20 years ago, the amount of dependence on the rain-fed crop. Firstly, there are 2 crop cycles. The other is that a lot of it is irrigated. So the relative importance of rain as far as the rain-fed crops has reduced. You will get newspaper headlines. You will get an inflation problem. It is not as stark as it used to be. Okay. So things have improved. They can get better, no doubt, but they are improved. On top of that, we believe that this government, through DBT, has made it a lot more efficient to specifically target where there is a problem, rather than having a cross-country kind of model, right? So if you have a spatial distribution issue, and you find that there is one state which is facing an issue, or 16 districts which are facing an issue, they can specifically target that. And so the efficiency of actually spending money to alleviate problems on the rain will have got better over a period of time. So, one, if there is an issue with monsoon, will there be an issue with two-wheelers and with some of the FMCG? Answer is yes. Okay. Is that going to derail the economy? Answer is no. Is that going to derail the market? Answer is probably not. Okay. It is kind of built into our 12% forecast, versus 18% for the market. What, however, we believe is that an overstated risk is the fact that at the back of the mind, the investors could believe that in a bad monsoon era, will the government lose sight of the currency, will lose sight of the external vulnerability, fiscal deficit, and all that? We think it is not going to happen.
Yeah.
Given all the things that I'm saying.
Sure.
So it's a smaller risk. It's a risk. The only thing that we are saying is that finally it's a risk. So at 18%, it is not priced in for Nifty earnings, but at 12, I think it is probably built into that. So let's be realistic on the numbers.
Yeah, but no, with regards to the portfolio allocation, Unmesh, that if indeed infra by itself is helping the rural balance sheet and helps the rural spend, and if it's not an El Nino year, then there is value in two-wheelers, value in FMCG by virtue of the sideways movement that they've seen, versus maybe and overweight in banks where the risk of the NIM speaking out is fairly stark, looking at the limited commentaries that we've heard thus far in Q4. So why not allocate money there versus keeping a very large overweight in pockets like banks, for example?
No, fair enough. See, let me answer that in two ways. Okay, one is that large banks is also a consensus call. So what you are saying is that if I put money in a consensus call, how do I make money? Well, it's just fine. The thing is that you will get whatever is the growth, because I don't think that there is that much scope for expansion of multiples, and that's the point. I think I will also concede. The point, however, on the other side is that betting on monsoon, okay, is not something that I have ever done, and I don't think that as a strategy we will do, because there is no evidence or any data for us to prove that that estimate about El Nino is going to be wrong. Okay. Or right also for that matter, but at the same point in time, if there is an expert with supercomputers sitting, the fastest supercomputers in India work on the monsoon, right? So we will see. And also what happens is you can price it in. So again, bringing back to my point, right? If it is a standard deviation below, you say it's okay. It's priced in, right? If you're a standard deviation above, how do you price in a monsoon where the standard deviation is above? So if it was 15 times earnings, 16 times earnings, you say, chalo, theek hai, I can allocate money, because if the numbers come down, you are already kind of paying for it. So it doesn't matter. Yeah. Not when the market's expensive.
Okay, fair point. So then let me actually, before I ask you how are you creating alpha per se in that 20%, where is it that you are in contrast with the market? One follow-up question on the pocket, which is IT services. And the jury is out and nobody knows who will be right, who will be wrong. I have a slightly different question in that when I look at Q3 conversation from most ER&D companies, which are also an alternate, so to say, the club as IT, but let's assume they're a slight alternate, their commentary, their order books, their business seems to be a lot better than what pure play IT services headwinds are. Is that a reasonable alternative to people who want that? Unmesh, can you hear me?
Yeah, sorry, I just lost you for like 2 seconds, I think. Yeah, sorry about that.
But if you can hear me now.
Yeah.
ER&D companies versus IT services. Are ER&D stocks a good alternative to people who want the IT service kind of businesses in their portfolio, or not really?
See, the answer is prima facie yes. Okay. The issue, however, is that as far as the IT services companies are concerned, the macro headwind, so as to speak, now seems to be quite real. Okay. Is that something that was expected? Answer is yes. Okay. I remember distinctly that for the last 6 months, while we've had 1 or 2 overweight positions in there, in our model portfolio, we were generally 160, 170 bits below. Kind of to play this macro risk. We didn't know where it will come from, but it's now come from there, right? So some bank blows up and then, there is some concern on that. So that is there. Is ER&D a better solution? Answer is yes. Do you think that it might be enough to offset what is happening in the larger? See, as a pack, it's dominated by the TCS and Infi types, the large caps. Will you be able to get alpha out of the entire pack because of that? Answer is no. So you have to go bottom up. So you think of it as a bottom-up alpha position and you invest, you might not get something for a while though in this space, given the overall negativity which will be there in those. And also, again, while, okay, valuations come off as compared to what they used to be, it's still not that much. So what you would do is that you would want to keep using any kind of such dislocations to invest from a 12 to 18 month kind of perspective. So the answer is, be nuanced about it. Don't try and go all in. Right now, probably not the best environment, because we don't have a handle as to how the demand scenario will play out at this moment in time.
So even for pure play ER&D companies like, say, maybe a KPIT, LTTS, Cyient, etc., you are not quite going there.
So Cyient, we have because we cover that name, so we have an overweight position in our. So that's what I'm saying. So it is an overweight position in our model portfolio. But the overall IT basket is not, and that headwind is difficult to overcome with a small name, because how much can you build in position? Can you build in a large, in a multi-cap kind of portfolio? So yes, Cyient is there, but will it be enough to offset? Answers probably not.
Got it. So how is it? I mean, a final question really. How is it that you are trying to generate alpha if, as you said, the 80% is in pockets which are durable, which are known, which are probably market consensus? What is within that 20% where you might be in stark deviation from what the market might be?
So I think on some of these smaller cap IT names, in fact, Cyient, we also have some couple of the auto ancillaries. We have certain, but they're all bottom up now.
Sure.
None of these is now linked to the macro, because the more you think about the macro, the less easy it is to actually deal with that. So we have that. We have some of the insurance names in there. We have capital market names, even though right now it's not going through a very good time. But we believe that eventually these things are, are longer term thematic. City gas names are there, which are overweight in there. So this is broadly, we like tractors also, like specifically within all of this, even though there is a rural problem, but we believe that tractors are something which will do well. So we are not that positive on the rural consumer buying two-wheelers, but we are okay with the tractors. So there are these specific names in there which we are playing. So long-term theme, and large banks, we are okay, even with the consensus position, with the kind of growth that they're delivering, we can get book value growth kind of returns. So I think we are quite comfortable doing that. And industrials, we have a fairly overweight position, even in the second tier names, because L&T, beyond a point, how much can you own, right? So some of the road names are there. KNR is there. Some of the capital good names are there. I think Cummins is in there. So there are all these.
Okay. My final question, Unmesh, how do you account for, or what is the probability of your thesis of there not being a sharp downtick in markets turning out to be false? What could lead to this? Could it be an external factor, or could it be earnings driven for the markets to come off very sharply, as opposed to what you believe?
So our core thesis is the market's not coming off very sharply.
I know, which is what I'm saying. What could lead to your thesis being wrong?
Being wrong. So look, when do markets come off very sharply is when you get a liquidity rush. See, earnings never, very rare. I don't remember, in fact, in my career, with the exception of 2008, where there was a very sharp downtick in earnings, okay, which caught us by surprise. Okay, usually what we've seen in each of the remaining, let's go back 20 years from 2003 till today, let's say 20 for some reason, but you will find that so 2 times only I have seen where earnings were overly negative. Normally what happens is that earnings are always on the higher side at the start of the year, and then they kind of come down. So the remaining 18 years out of 20, earnings are here, and then they keep coming down. But you will see that with that one exception, sector specific might happen, okay, but I'm saying overall for the market, with that one exception, I don't think that we've seen a sharp correction in earnings where earnings get cut 30% across the board. Right now, if you look at the numbers, okay, how will the earnings get cut so much? Inflation is already an issue, okay, geopolitical problem is already there. So kind of where all these things will go is understood. So the only way a big market dislocation to a large extent will happen is if there is a very strong issue of liquidity getting sucked out. Basically, the multiple has to contract.
Sure.
Because anyway, see, we are at 12 and 18. While it looks like a very big number, it's finally 6%, right? In the broader thing of things. So market falls 6%. Again, we are also in the same place where they are. So aisa koi bada amount nahi hai. It's not such a big amount, that 6%. So now coming to how will that multiple get sucked out? Look, now this is a risk. I don't believe it will happen, but the risk is that if the fight against inflation in the US specifically, and especially in the Western world, so as to speak, is something where they continuously keep losing battles, then at some point in time, there will be pressure on the Fed to very materially suck liquidity out, which means accelerated quantitative tightening, which is happening at a fairly slow pace right now, and an ultra conservative view that is taken on the interest rates, right? So instead of 25 bits, which is our base case right now for next week, you get 50, and then they say this will continue. And at this moment in time, I believe that the dot plot, or the market, at least, from the terminal, seem to suggest that the market participants actually expect a rate cut at the end of the year. I'm talking about the calendar year. Firstly, we are not in that camp. Second is, even let's say that gets pushed out, and not only that there is an expectation that actually the interest rates will go up further beyond the 25-50 bits. That is a place where you could get a dislocation. But honestly, the probability of the Fed messing up so badly, okay, because this will mean somebody missed the point completely. I think it's a little tough Okay, it's not like it's never happened before. Okay, so in the 70s, this thing has happened where you had a number of years where they were getting it wrong on the inflation, but I don't think that we are in that place yet. So will there be a dislocation? Answer is no. Which is why it is tougher, In fact, a dislocation is easier, because while you feel quite bad about your existing portfolio, you can bite your tongue and go back in. When there is a slow grind in the market, it's a lot tougher to navigate, and that is where we seem to be finding ourselves right now.
Hopefully, it's easier on participants than what it seems like for right now. But Unmesh, great talking to you. Thank you for taking the time out and being with us today on Talking Point.
Thanks, Neeraj. Thank you so much.
And viewers, thanks for tuning in to this conversation.